All right, today we are digging into a fascinating and, let's be honest, a kind of weird story from the world of investing, Altria Group. We're talking about a company whose main business is famously shrinking. And yet, somehow, it's been one of the biggest stock market winners out there. So, how does that work? Let's figure it out. I mean, this is the big question, isn't it? It feels like it breaks all the rules. You'd think that for a stock to do well, the company has to be growing, selling more stuff every year. But that's not what's happening here. The secret is actually buried in the numbers, and we're going to dig it up. So, first things first. Before we get into the how, let's just confirm the what. Just how good of a winner has Altria actually been for the people who own its stock? Wow, yeah, just look at that number. Over the last 15 years, we're talking a total return of over 543%. Let me put it this way. If you'd invested 10 grand, it would have turned into more than $64,000. That's not just good. That is an absolutely phenomenal return. So yeah, part one of our puzzle is confirmed. This thing has been a wealth-creating machine. And this wasn't just some one-hit wonder like a lucky stock pop. Nope. This breaks down to an average return of over 13% every single year for 15 years straight. That kind of steady compounding performance is exactly how you build serious long-term wealth. So the winning part of this puzzle? Absolutely, 100% confirmed. Okay, so that's the good news. But here comes the twist. This is the part that makes this whole thing so confusing. The actual business itself, well, it's getting smaller. And this chart just lays it out there in black and white. Look at the revenue growth. It doesn't matter if you look at the last year, the last 3 years, or the last 5 years. It's all the same story. Those bars are all in the red. Sales are going down, consistently. Year after year, less money is coming in the front door. Which, brings us right back to that massive question. But now it feels even crazier. If the company is literally selling less product, how in the world is it delivering those monster returns to investors? Seriously, where is all that cash coming from? All right, here's where we start to crack the code. The secret isn't at the top of the income statement with sales. No, the secret is how ridiculously good this company is at turning every dollar of sales into cold, hard profit. Check this out. This is Altria's gross profit margin. And what it means is pretty simple. For every single dollar of stuff they sell, they get to keep more than 61 cents as gross profit. That is an elite, world-class number. They can do that because they have incredible pricing power, which means they can turn fewer sales into huge profits. Now let's look at maybe an even better way to measure how efficient a business is. It's called return on invested capital, or ROIC. You can think of it like this. It tells you how good a company is at turning $1 of its own money into more dollars of profit. And Altria's ROIC is just staggering, 27%. To put that in perspective, a lot of really fantastic companies would be thrilled to hit 15%. A number this high tells you that this business is a cash gusher. It doesn't need a lot of capital to operate, and every dollar it does use just generates tons of cash. So here's the key. Yeah, it's a shrinking business, but it is an unbelievably profitable one. So what does a company do when it's just gushing cash, but doesn't really need to reinvest that money to grow bigger? Well, it has a choice. And Altria's choice, this is the absolute key to solving this puzzle. It gives the cash directly back to the owners of the company, the shareholders. 56. That's a huge number. For 56 straight years, Altria has given its shareholders a raise. They have increased their dividend payment every single year. It's not just something they do. It's basically the entire point of the company. Returning cash is their whole mission. But given everything we just said about declining sales, you have to be asking yourself the big question. Can they really afford this? Is this sustainable, or are they just running on fumes? Well, the numbers say yes, they can absolutely afford it. Look at this, more than $9 billion in free cash flow just in the last year. And it's so important to understand what free cash flow is. This isn't some accounting number on a spreadsheet. This is the actual cash left in the bank after paying all the bills to keep the lights on and run the business. And this chart really puts it all into perspective. Out of that huge $9 billion pile of cash, about 77.5% of it goes out the door as dividends. Now, that's a big chunk for sure, but it means the dividend is safely covered with billions of dollars to spare. Okay, this slide is super important because it clears up something that confuses a lot of people. You might look up Altria and see a payout ratio over 100% and think, whoa, they're paying out more than they make. The dividend's in danger. But that's based on accounting net income. When it comes to paying a dividend, cash is what matters. The free cash flow payout ratio on the right tells the real and much safer story.
So we've got this super profitable cash cow. But if you start poking around the data sheets, you might see some other numbers that look, well, just plain weird. So let's quickly clear those up before we talk about value.
Yeah, for example, you might pull up a stock screener and see a negative price-to-book ratio or a crazy-looking debt-to-equity ratio and just think, what is going on here? Something must be terribly wrong. But there's actually a pretty simple explanation. For decades, Altria has spent billions and billions of dollars buying back its own stock, which is just another way to return cash to shareholders. But because of a weird accounting rule, doing this for a long time can actually make the company's book value go negative. It's not a sign of trouble, it's really just a side effect of their main strategy. So, given all this, how do people even try to figure out what a company like this is worth? Well, one popular way is called a discounted cash flow model. It basically tries to guess the value of all the cash the business will produce in the future. In this particular model, it suggests a pretty big margin of safety, which is just the gap between the current stock price and what the model thinks the business is intrinsically worth. All right, let's put all the pieces of this puzzle together. Let's step back and look at the whole picture so we can see exactly how this machine works. So here it is, the whole engine in 3 steps. Step 1, you start with a business that has slowly declining revenue. We've seen that. Step 2, that business is so wildly profitable that it's like a fire hose of cash. And step 3, because it doesn't need to pour that cash back into growing, it just turns that fire hose around and aims it directly at its owners through bigger and bigger dividends. That's it. That's the model. And that's how you solve the puzzle of a shrinking business creating winning returns. This financial engine has worked like a charm for decades. But it leaves us with the one massive, multi-billion-dollar question for the future. Can this machine keep running forever, or will those declining revenues eventually starve the engine of its fuel? That is the question to think about.